Ladies and gentlemen, good day, and welcome to Gateway Distriparks Limited Q3FY22 Earnings Conference Call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. Today on the call we have Mr. Prem Kishan Gupta, Chairman and Managing Director, Mr. Ishan Gupta, Joint Managing Director, Mr. Samvid Gupta, Joint Managing Director, Mr. Sachin Bhanushali, Chief Executive Officer, Mr. Sandeep Shaw, Chief Financial Officer, and Mr. Manoj Singh, Senior VP, CFS Business. And now hand the conference over to Mr. Prem Kishan Gupta. Thank you, and over to you, sir.
Thank you. Good evening and a warm welcome to all the participants. First of all, I want to inform you that the amalgamation process which we had started during the last fiscal year, has been completed. With effect from 28 December 2021, Gateway East India Private Limited and Gateway Distriparks Limited have merged with Gateway Rail Freight Limited. Subsequently, Gateway Rail Freight Limited changed its name to Gateway Distriparks Limited on 11 February of this year. So now our rail, ICD and CF businesses are all under one umbrella, Gateway Distriparks Limited. In the new entity, we are now able to offer a pan-India network of ICD and CFS to shipping lines and admin customers. A stronger balance sheet and combined cash flows of all businesses will provide added impetus to our expansion plans of setting up new ICDs in the industrial hubs of northern and western India while maintaining a low level of debt. With the share of exports from India rising, we are facing less imbalance and are able to run higher level of double stack operations both ways, thereby further reducing our per unit cost, which is further helped by our unique hub and spoke operations between Gadi Harsaru and Viramgam, providing us an advantage over the other operators. This also helps us with increasing our market share. In general, the importers and exporters are becoming more and more inclined in favor of using multimodal transport with long distance covered by rail, as opposed to road transportation, and we see this trend continuing. On the CFS front, I would like to update you that the 15 years period of our O&M agreement ended at Punjab Conway CFS in Nhava Sheva on 31st January of this year. We fulfilled our obligation to run it through the entire period of the agreement, even with a loss in the past few years. We did not participate in the new tendering process as it did not make any commercial sense on the terms as per the RFQ. We are still servicing the Nhava Sheva market through our own CFS and have seen occupancy levels going up there. In fact, across all our CFS facilities, due to increased manufacturing activity in the country, there is a higher throughput that has a healthy impact on the financials. Our results, press release and presentation have been uploaded on the stock exchanges as well as the company website. I hope you had an opportunity to go through the same. I'm sure you are all pleased with our performance in this quarter, and we anticipate sustained growth with healthy operating margins over the forthcoming quarters. With this, I will now hand the floor for questions and answer session. Feel free to ask anything, and the entire management is there to answer your questions. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Mukesh Saraf from Spark Capital. Please go ahead.
Yes, sir. Good evening, and thank you for the opportunity. My first question is for Sachin, sir. On the rail haulage side of it, and the rebate and the discounts that we are getting from Indian Railways, it's ending, probably by end of April. So just wanted to get a sense, would we be kind of increasing prices and maintaining this kind of EBITDA per TU, or how are we going to kind of both the rebate of 5% and also on the empty running?
Yeah, thanks, Mukesh. The 5% rebate on laden rail haulage charges and 25% rebate on empty rail haulage charges ends on the 30th of April 2022. We have already represented to Indian Railways that the growth which has been seen by this sector is primarily due to the softer pricing regime, for which we have been representing for a very long period of time, has helped. And because of that traction, overall volume of business which is done by Indian Railways through all the operators has increased. So that's the first part of the story. The second part is that if this rebate eventually gets rolled back, then all the operators will have no alternative but to take a price increase. The reason for this is that this rebate was given on account of imbalance which existed on account of import-export imbalance during the COVID times and later period. Right. While there has been some correction in the imbalance cost still continues to be staggering. And in order to take care of this cost, all operators will have no alternative but to take an increase. So I'm anticipating that there will be an increase if the benefit of rebate is rolled back by Indian Railways.
Right. And just in continuation with that, we had already taken about 1,000 rupee kind of hike around October. Is that right? Per container?
It is not exactly in October, but on two different occasions in two different markets we have taken a price increase.
Right.
And that has improved our margins apart from the benefit of reduction in unit cost which was mentioned by Mr. Gupta.
Right. And second question again is on this expectation of some bit of shift from road to rail, and one aspect of that is obviously the timetable scheduled services kind of a thing. So could you give some sense on in terms of currently of the rakes that we are operating or of the number of services we are operating, what proportion do we offer a time guarantee kind of service?
So we were one of the first to benefit from the Freight Express service which was started by Indian Railways on 15th of August 2021. And we also enjoyed the lowest time as far as all NCR terminals are concerned. So currently we have a 48 hours target time for Mundra Port, 53 hours for Pipavav. And we have been able to run all our export services at much lesser time than the target time. Our average for Mundra Port hovers somewhere around 30 hours, whereas in case of Pipavav Port, we have been able to do our services in under 45 hours. This has resulted into reliability setting in, but currently this benefit is available only in the export direction. In the import direction, similar transit assurance has not been offered by Indian Railways. Their apprehension is that all the terminals are not able to release the rates, and that is why congestion takes place, and that results into delay in transit time. We have submitted data to Indian Railways, which kind of demolishes this argument. And at least there are some terminals where adequate handling capacity as well as holding capacity outside the terminals is available, which may be able to offer similar services. This, along with the dedicated freight corridor running, which has increased almost about 60% of the total traffic on this route, will result into definitely a shift from road to rail. The reliability of the transits, particularly on Mundra Port and Pipavav Port route, which are the preferred ICD ports currently, will also result into a lot of sourcing getting converted from break bulk to containers. Both this put together is expected to give a very healthy increase in the overall market, and we are confident that we should be able to address the needs of the market even at higher volumes.
Right. And this should probably happen in the next few months, or when can we expect this to happen in the import direction as well?
This is more about production psychology. So unless they experience the reliability over a longer period of time, sustained shift may not take place. So I would consider that the entire year 2022 and the year 2023, when part of the feeder routes into the dedicated freight corridor start becoming dedicated freight corridor compliant, we will see this growth. My expectation is that this growth will be spread over next 3 years, that is next 3 calendar years, that is 2022, 2023, and 2024. By that time, we should have the Nhava Sheva segment of dedicated freight corridor, the Sanand to Nhava Sheva also operational. This will further fuel the growth. So this is likely to result into a much longer duration growth, both in terms of organic volume growth on account of macros, as well as on account of modal shift from road as well as break bulk to containerization, which will take place. I would look at maybe 5 years as the golden period for this sector to grow.
Understood. Thank you so much for the detailed answer. I'll get back in the queue.
Thanks, Mukesh.
Thank you. The next question is from the line of Atul Tiwari from Citi. Please go ahead.
Yeah, thanks a lot. And congratulations on very strong performance and completing this amalgamation. Just a couple of bookkeeping questions. So first one is, when is the stock likely to relist and start trading? What is the estimate as of now?
Hi, it's Samvid here. So we've applied to SEBI and the exchanges, and the process is on. So we don't have a specific timeline in mind, but everything is being done from the company side. So we're waiting for the approvals to come.
Okay, so it is like, can it take like a couple of months, or it is like a matter of a couple of weeks? I mean, any kind of idea? Because I mean, I'm kind of pressing on this because we get a lot of questions from investors that when it is likely to release.
Yeah, even we would like to know the answer to this, but we don't have any clarity. It's all on SEBI and stock exchanges right now. So once we have an update, we will be sure to let everyone know. Having said that, it typically doesn't take months from this stage, so it's a matter of some weeks.
Okay. And another one, so now the name of the listed entity will be GDL only, right? So there is, and all the codes, etc., Reuters code, etc., will remain same. So nothing changes as far as the naming front is concerned.
Right.
Okay. And finally, the last one. So now, is it fair to assume that now that everything is in one company, the effective tax rates could change? And what will be the new effective tax rate we should be working with?
See, in the CFS business, we have exhausted all the tax rebates. But in rail, we still continue to take the tax rebate at, under ATIA. Which is still valid for the next 7 years or so. And thereafter, I mean, we'll have the MAT credit, which we can. So, I mean, we will be having a friendly tax rate for the next 10 years in the rail business.
Okay. So any comment on, what is the numerical value we should be working with, like 20%, or it could be even lower than that?
Sandeep, can you please answer this? What will be the average tax rate?
The MAT rate, it will be 17.47 for next 10 years.
Okay, so the MAT
is in the range.
Yeah, MAT rate currently it is 17.47, including surcharge and all that.
Okay, so 17.47 for the entire entity, all the businesses put together, roughly.
Sandeep, I think on the CFS it will be slightly different.
Now it's a merged entity, sir. So for merged entity, everything will be now considered, and that will be in a MAT design for next 10 years based on the profitability of the company.
Great, sir. Thanks a lot. Quite clear.
Thank you. The next question is from the line of Mr. Achal Lohade from JM Financial. Please go ahead.
Yeah, good evening. Thank you for the opportunity. Sir, my question is, in terms of the rail volume, we see that we continue to do extremely well on the rail volume. So if you could help us understand, in terms of the market share, like you talked about that in the past calls, how has the market share moved in last, let's say, 9 months or YOY for the third quarter? And, how's the pricing environment or competitive intensity in those two pockets? If you could highlight the same, sir.
Sure. So, should I go ahead and answer this? Or someone
Yes,
else?
sir.
Yeah. So the market share primarily in NCR has grown to a level of 14%, while the overall market during the quarter has increased by 3%, 3 to 4%. We have been able to grow in NCR market alone by roughly about 18%. So this has been a product of the products that we rolled out, the transit assurance scheme, as well as the CFS-based services, particularly services according to the requirement of the customer, the solutions approach that we have. And we have been able to consolidate with our existing customers as well as with the customers which are not being serviced by us. In Ludhiana, we continue to operate at 35% of market share. There hasn't been much growth in that market, nor has there been much shift between the operators. The way forward here seems to be that consolidation in NCR market is a good opportunity, but it is going to be tougher and tougher going forward to increase market share. In Ludhiana market, the competition is expected to intensify with a new CFS becoming operational, new ICD becoming operational, and that will result into some amount of competitive pressure both on prices as well as margins there. The exposure in Ludhiana market is roughly 7,500 containers out of 25,000 containers that we do every month. So there will be a little bit of pushback there.
Understood. And, in terms of the benefit of the DFC, like you said, on the export direction, there is the timetable or, transit guarantee, time guarantee. What is the extent of benefit we are already seeing in the numbers, in, let's say, 3Q numbers? Would you be able to quantify the benefit of DFC in terms of the efficiency, turnaround time, or double stacking?
It's a complex number, I would say, because it results into more reliability setting in, and that reliability results into more business coming your way. So growth as well as a reliable service on account of connecting all containers to the designated vessel does result into market share. And I think because of our locational advantage as well as the quality of service that we offer on rail transportation, we have been able to, as I mentioned to you, increase our market share much higher than the growth in the overall market. I don't think it will be possible for me to kind of dissect it and give you numbers pertaining to that this was on account of growth, this much of increase was on account of assured transit time. But it's a complex play, and finally what matters is how have we been benefited. So we have a 15% edge over the market currently in terms of our growth.
Perfect. And just one more, if I could, with respect to, the CFS business, how much was Punjab Conway's contribution in terms of volume, revenue, and EBITDA, if you could quantify? That's one. And number two, the capex for FY22 and 23, if you could talk about that.
Yeah, so we don't give location-wise EBITDA, say within the CFS and all, but Punjab Conway was roughly doing 10,000 containers a month, and now we've given it up. So the volume was less than half of that in January and December, but CFS1 volumes have increased. So we did manage to ship some business and gain some other business from the market. So while throughput might appear to go down going forward, since we couldn't move the entire business of Conway due to capacity constraints, we still expect EBITDA will be in a better off position.
Yeah, we'll be having much healthier margins because as I mentioned earlier, that we were running losses at Punjab Conway because of the outgo of the annual fee, which was to the tune of about 20 crores a year. But since we had an agreement, we continued until the last day. So now, at least in the CFS business, 2 years back we sold Chandra CFS, and now Punjab Conway is not there. So these were the only two locations which were EBITDA negative. So that and with the occupancy level in CFS at Nhava Sheva that we own, which was to the tune of about 60-65%, has gone up to 80% or 85%, and we expect more volumes coming up with some minor adjustments in the warehousing space and the yard management. And since the dwell time has gone down considerably in the last few years, so the capacity where we can hold containers at any given point of time and the resultant volume in the full months will be much higher than previous year, many years, and not only last year, but so this year we'll see healthy growth in CFS at Nhava Sheva. Other CFSs also, I mean, the volumes and the imports and export, both exim business have increased at the port towns also. So we are looking at higher numbers at all the locations.
And on the capex plans that you had asked, so it won't be more than 5 to 10 crores for the CFS business. This is basically adding some warehousing and some vehicles.
But in the rail business, the capex, say, in the next 2 years will be to the tune of about 200 crores.
That 200 crores is cumulative or annual, sir?
No, cumulative. So we'll be looking at 2 terminals, 2 more terminals in the north.
Yeah, so those 2 terminals will be roughly 125 crores, and then there'll also be the fleet replacement and general increasing of capacity within our existing terminals. So anywhere from 150 to 200 will be the overall outgo for the rail business.
Understood. And have we identified the location or the land acquisition is already being done?
We have identified what you can say the area. We mapped the area where, I mean, we don't have a specific location in mind, but yes, we have, particular geographical locations, 2 locations, but we will be only able to tell that once we acquire the land over there. So these 2 locations will be, I mean, of course, it will be coming in the next financial years, but we definitely have plans to go ahead with these 2 satellite terminals.
Got it. Thank you so much. If for any questions, I'll come back in the queue, sir. Thank you.
Thank you very much. The next question is from the line of Vikram Vilas Suryavanshi from PhillipCapital India Private Limited. Please go ahead.
Yeah, hi. Good evening, sir. Most of the questions were answered. Just to understand more about this advantage on the DFCC as well as the increased volume, or what is the current double stacking, what we are doing, and is there any further scope for double stacking in? So any comments on the double stacking opportunity?
So we continue to be doing double stack in both import and export direction, and our numbers have intensified a little bit. Though we don't share the numbers of actual double stack which is taking place, but we still kind of are within the 40% double stack that we used to do, 36 to 40% double stack that we used to do. We are kind of shuffling between these numbers depending on the imbalance in traffic. Going forward, the advantage of additional double stack will come only when the entire dedicated freight corridor becomes operational with 25-ton axle load permitted on the new platform, new wagon, BLCS wagon, which is currently under trials. So unless both the things happen, that the dedicated freight corridor allows 25-ton axle load wagons to operate at 100 kilometers per hour on dedicated freight corridor, and maybe some restricted speed, say 75 kilometers per hour on the rest of the network. The next big jump in double stacking is not expected to come. However, because of reduced transit time, our ability to carry more containers per train has helped us in increasing productivity of our trains, as well as resulted into some improvement in our double stacking indices.
Got it. Sachin sir, further, just to get more clarity on this rebate, this additional 25% rebate what we have on this MT, is that significant enough to attract empty container movement on the rail, or that was not much material impact on operations?
So generally, if you see, we have been carrying empty containers as a part of promotion of export when the empties come from port. And whenever there is a surplus of imports, we have to carry empties back to the port because the shipping lines need to carry these empty containers where those are required, or to ship those out to international locations. The empty business has been operated by all operators at a reasonably high discount, with not much margin in that business. It is seen more as a cushion rather than a margin-making business. The shipping lines are also generally allocating most of the exports to those who carry their empties in a friendly manner, both from a commercial as well as operating point of view. And that is why this business has not been a great business either for us or, as per my belief, for any other operator in the market as well. But it will continue to be there. Roughly, this constitutes about 5% of our total business.
Got it. And last question on this two terminals, what we are planning to develop, how much time it will take to really come to the operation, or where we are in terms of a process? Is the land acquired or development started, or if you can give some more clarity on that?
Yeah. Mr. Mehta, would you like to take that?
Yeah, I'll take it. So the land is identified and shortlisted, but we haven't finalized on anything yet. So construction takes about 12 months for an ICD, and then after that it takes 12 months for ramp up of volumes. These won't be done at the same time, so there'll be a slight gap also of say 6 to 12 months between both the facilities. So we're looking at say 3 years overall for these two projects.
Got it.
To be fully up and running with volume.
Got it, yeah. Thank you very much.
Thank you. The next question is from the line of Sumit Kishore from Axis Capital Limited. Please go ahead.
Good evening. Thanks for the opportunity and my compliments on completing the business restructuring. My first question is regarding DFC, the Madar-Palanpur route. Is it still under operational trial, or is it fully commissioned now? And when do you expect to cross, say, the 100,000 TEU per quarter mark, from the current levels that you are?
So the dedicated freight corridor from Palanpur to Karjoda, which is from Rewari to Karjoda, which is the current phase 1 of dedicated freight corridor, is fully constructed. The signal and telecom equipment and the overhead equipment which provides the power for electrical locomotives is in the process of getting commissioned and powered, and that is the reason why currently the half of that portion, about 400 kilometers of the dedicated freight corridor from Rewari end to Ajmer is considered to be fully operational. The rest of half of it is considered to be under trial. We expect that it would become fully functional, and practically 100% container traffic being carried on dedicated freight corridor by end of the current calendar year. It may happen a little earlier because there has been an effort on the part of dedicated freight corridor to expedite these works which were lagging behind. To answer your second question would be a little, I would say, looking into the future, and there cannot be a definitive answer. So I would rather respond to it by giving you an idea about percentage growth that we are expecting rather than looking at the number. Currently, we are about 75,000 laden TEUs and about 10,000 empty TEUs that we are carrying. We carried during the last quarter, wherein there has been an increase in our empty practice. We expect that we should be able to grow in double digits going forward, provided the timelines are maintained by dedicated freight corridor in commissioning, as well as the overall macroeconomic environment, which currently seems to be driven by consumption, also continues to be bright. The market doesn't seem to be growing as much as we expected it to grow, at least in NCR. But we'll continue to make our efforts to ensure that we gain market share on account of our superior product in terms of our operating deliverables, as well as our attractive commercials and integrated services that we provide. We should be able to claw back some market share in our favor.
Okay. How much of a difference would electrification on the balance portion of phase 1 really make when it comes to efficiency?
There won't be any difference. As far as electric traction and diesel traction is concerned, it is completely neutral from the speed of trains point of view. The signaling is going to make a difference because currently all the signaling equipment are not commissioned. And that is why automatic signaling on the entire 800 kilometer stretch are not operational. It is operational only on the 400 kilometer part of it. So the overall run time on this section of dedicated freight corridor improve when the electrical equipment become operational. But these electrical equipment are operational on the signaling equipment are dependent on the electrical equipment becoming operational as well. So both the things are going to happen simultaneously. It should result into another 5% savings as far as the running time of the trains is concerned.
Okay. And again, just to understand this better, what is the difference in your rail transit time from Garhi to the Gujarat port in the import and the export direction right now?
Exports take roughly 15% to 20% lower than imports. Particularly for Mundra port, it is about 20%. For Pipavav, it is about 15% less time taken by exports as compared to imports. We have been able to run our operations at Gadiar-Saru hub quite efficiently. So we have not been facing much pressure of too many trains running in Gadiar-Saru direction, and we have been able to be fluid. And that's the reason why the impact is not as much as it is on some other operators.
So exports take 15 to 20% more time than imports.
Exports take less time.
Less time, yeah. That's what. Yeah. Right. And what is the capacity utilization of your train sets now, and how much investment or when would you need that investment to extend your fleet?
With the double stack operation and hub and spoke operation at both Gadiar-Saru and Viramgam, we have the productivity of the trains is primarily dependent on how well are we able to run our train services. The capacity is a variable phenomena. If you look at how well we have been able to run our train services as compared to last year, this year we have been able to increase our capacity by roughly. So last quarter we had done 67,000 containers. Against that we had done 85,000 containers this quarter, and there has been no change in our fleet. So this primarily comes because of the turnaround time improved, and turnaround time is going to be the biggest contributor to the capacity. So going forward, we should be able to handle another 10% growth without addition of new train sets. But we also have plans of inducting the 25-ton axle load BLCS wagon or spine wagon, which is going to be available in the market in a phased manner over a period of next 2 to 3 years in order to increase our capacity. It would also feed into the new terminals which were mentioned by Samvit and Mr. Gupta. To do operations at those locations.
Sure. Finally, while you've touched upon this, for the Punjab Conware one-time agreement which ended, what was the EBITDA contribution from there? Was it a loss? And so in absolute terms, are you saying that the EBITDA will actually go up X of Punjab Conware?
Yeah, so we don't give detailed breakup EBITDA by location, but towards the end, basically in the last year, Punjab Conware was EBITDA, and in the earlier years it used to be profit making.
Okay, so would you have any sort of guidance on what kind of EBITDA per TEU should we assume in our models for?
No, so earlier calls we've stated a target of 2,700, 2,800. So we're looking at that only as a CFS target.
Okay. Thank you so much for answering my question.
Thank you. The next question is from the line of Aditya Mongia from Kotak Securities. Please go ahead.
Good afternoon, everyone, and thanks for the opportunity. My question related to the hub and spoke structure, which is benefiting Gateway Distriparks, and I wanted to get a sense whether the recent commissioning of the Swarupganj terminal of Concall is having any impact. The way I understand it, railways have extended the telescopic pricing at this terminal, and I wanted to get a sense whether that is creating any amount of higher competition of price overhang for you.
So railways have reduced the hub-to-hub distance from 750 kilometers to 500 kilometers some time back in order to address the request which was being made by Container Corporation. So that is how the Swarupganj terminal also becomes eligible for hub and spoke benefit. It is experimental. It is going to be for a period of 1 year, and some financial analysis is involved in that. As far as its impact on our operations is concerned, there has been no change in the double stacking that we do or the business that comes our way. It is not expected to have any impact on our operations either.
Sure, noted. That was actually the only question from my side. Thank you.
Thank you. The next question is from the line of Vipul Shah from Sumangal Investments. Please go ahead. Vipul Shah, may I request to unmute your line from your side and go with the question, please?
Yeah, there is a sequential drop in EBITDA per TEU in the rail business. So can you explain the reason for that? Hello?
Yeah, sorry, which numbers are you referring to?
So it is 9,235 in quarter 2 of FY22, and against that it is 9,021 in quarter 3 of FY22. In your slide number 22.
Yeah, this much variation keeps taking place on account of volume mix and imbalance. So I wouldn't say it's a massive drop as such. It's just a 2% drop
Okay, but what should a steady state EBITDA per TEU we should assume?
I think 9,000 is a good number as the base for now.
And what sort of volume growth we should expect? Low teens per annum?
Yeah, low teens is what we're looking at also. I think this was answered earlier as well.
Okay, and lastly, I missed the CapEx comment by the chairman, sir. So what is the CapEx in the rail business for the next 2 years?
Yeah, so it's 200 crores, and out of that, it's basically 2 terminals will take up around 120 to 125 crores, and the balance is for increasing capacity in our existing locations and buying handling equipment and trailers.
So please plead I'm sorry for my ignorance, but what do you mean? What is the difference between a satellite terminal and a main terminal? If you can explain briefly.
So the satellite terminal will basically feed into a hub of Gadi. So it won't mean that it's a main terminal as in that it won't be a hub. It will add into volumes at Gadi, and then from there we will use a hub and spoke advantage to add more volumes.
Okay, sir. Thank you and all the best.
Yeah. Thank you.
Thank you. The next question is from the line of Prateek Kumar from Antique Stock Broking. Please go ahead.
Hello. Yeah, good evening, sir. My first question is on the comment earlier during the call. Can we say that for Mundra we are taking 30 hours and Pipavav we are taking 45 hours? Is this the total to and fro time, or is this the one direction time which you're talking about?
This is transit time from departure from Gadiyarsharu terminal to arrival at the port. This is pure transit time. It doesn't take into account the time that is taken for handling of containers at the train, either at the terminal or at the port.
Okay, so we talked about 27, 28 hours, I think, in last call or earlier call, as in benefiting from DFC movement. So now we are taking 30 hours to 45 hours to Gujarat port. Has it increased over again?
We had spoken about 27 hours in the last call. That was the average during that quarter. Currently, the average for Mundra port is at 30 hours. Pipavav port at that time was over 48 hours, which currently has stabilized somewhere around 45 hours. These are the things which change on account of the total volume which is being moved on these routes, as well as on account of congestion at the port, volume of business which is being handled by each port. So it's not like clockwork that you can ensure that sequentially either it will improve or remain stable and would never increase. You get my point?
Yes. And sir, why would Pipavav movement would be so slower than Mundra? I thought Pipavav is connected more.
There are two primary reasons. One is that the distance is there is about 200 kilometers extra distance which has to be traversed. In addition to that, there is a single line section which is from on the Pipavav Rail Corporation segment, which is from just after Viramgam, which is called Surendra Nagar, all the way up to Pipavav is a single line section, whereas only about 250 kilometers on Mundra port is single line section. The rest of Mundra port route is double line section. So that's the advantage which is available on Mundra port. So the trains don't have to stop to cross each other's paths on Mundra port, whereas there is such a need on Pipavav port. Pipavav port volumes are much lower, and that is why double line construction is not considered as necessary on that route.
Sure. Secondly, when we say that imports are have not shifted much on the SC route, while exports have started to shift, so that means that
no, there is some confusion. No one has said that. The DFC operations are at the behest of Indian Railways and continue to be operated by Indian Railways on dedicated freight corridor, both in import direction and export direction. The import directions have not been given transit assurance, whereas Indian Railways has given transit assurance in the export direction. That is the, let's say, statement of fact as far as DFC is concerned.
So those import volumes are like sort of getting de-stuffed at CFS at, let's say, Mundra, Pipavav or JNPT and moving by road to hinterland?
I think there is some misunderstanding as far as how the business operates. All ICD business, which is carried to all our port terminals, is carried from port directly from the port. It doesn't go to the CFSs.
Sure. Okay. I got it. And one last thing. Recently, in past 3-4 months, there have been some kind of slowdown or increased slowdown at Mundra and Pipavav port in terms of container volumes, while JNPT has done very well. So is this something which has hurt the container rail volumes as well, or this is impact which is related to transshipment volumes and doesn't hurt container rail operations?
It's actually on account of transshipment volumes. What you said is right, and there has been no change in the ICD volumes. In fact, ICD volumes continue to be as robust at all the 3 ports, and there hasn't been any shift of volumes either from Mundra port or from Pipavav port to Nhava Sheva port as far as ICD business is concerned.
Thank you, sir. These are my questions.
Thank you. The next question is from the line of Ashish Kacholia from Lucky Investment Managers. Please go ahead.
Yes, sir. Good evening. I have a question which is basically that we have heard that one of the largest port operators in the country is looking to take over Concall, and that will kind of put us in a disadvantageous position. So any thoughts that you can share with us if the ownership of the container corporation changes after privatization?
Yeah, see, firstly, there's still no clarity on when the divestment will take place, and there are other bidders also. So we don't want to comment on who's going to be running that the Concall after privatization. But having said that, we are looking at it from a point of view that in the overall market, Concall being the largest player and most of their terminals are not profitable, it will only help if a private player comes in. Because firstly, anyone who operates it would need price increases, which would be applicable for all players. Secondly, the push which is there right now, there is no marketing done by Concall. It is just an asset play. Whereas over time, this industry has evolved into offering solutions and services. So anyone else coming in and joining the fray will only help to shift the long distance transportation from road to rail. So we feel that it will benefit the industry as a whole. And on a side note, there are some issues which are yet to be resolved in the Concall divestment, which is taking the government time to figure out, which is regarding the land license fees, which you must have heard about or seen in the news. So until those things are clarified, I don't think that this will progress for the time being.
Okay, thanks. And my other question is basically, are we doing marketing of our services directly to the corporates so that they are choosing, or this is our business that comes to us comes via the freight forwarders or some other entity in between us and the corporates who are moving the material?
No, so it's a mix of business. Shipping lines are a large part of our customer base, through which the manufacturers or traders come to us. Then we have direct relationships with the corporates themselves. And the third is also the freight forwarders are also our customers. And a lot of the services which we offer are on a direct basis, like for example, warehousing or last mile or first mile transportation, then some other solutions which we offer to them. And a big chunk of it is through the shipping line. So it's the last part of the leg for the larger piece which they are contracting them for on the ocean freight.
Okay, so what percentage of our business would be coming directly from our B2B relationship with the corporates?
So on the CFS side, it would be much larger. But on the rail side, majority of imports, I'd say about 90 to 95% of imports are shipping line controlled. And on the export side, it could be anywhere from 50 to 60% would be direct with customers, and then balanced through freight forwarders and CHAs.
Okay, got it. And is this is it a sticky business once you start getting, say, you are saying 60% of the export business is coming directly from the corporate. So is this now extremely price sensitive, or this is a solution that you are giving? So the price is just one of the factors which goes into their decision making.
The first factor which is relevant for them is the location. The second is the service level. And then pricing, of course, plays a role. But there are some customers who pay us premium pricing if the first two things are fulfilled. So it's a mix of different factors. And when I say service levels, what they're looking for is not only from the customer service point of view, or the fact that they have online access to doing the transactions and all through the documentation is online. But the core service is that of rail service which we provide, providing vessel cutoffs, so that suppose in the case of export, our trains don't reach so late that they miss the vessel which they have to export on. Similarly, on the import side, if we don't clear on time, then they face detention and demurrage at the port. And then also we have provided a single solution because we have our own trailer, so we do last mile service, which many other players in this industry do not. So when someone comes to us, they get end-to-end solutions. They get a very customized solution based on where they are located, how to bring the empty containers to them, where the stuffing would take place, all kinds of things. We work out a solution for them and we provide that. So it's a mix of all of that. It's not only pricing.
Okay. And is there any difference to our life if the more traffic moves to Mundra or more traffic moves to Pipavav? Are we indifferent between Mundra and Pipavav, or we would prefer more traffic going to one of these two particular ports?
Sachin, you can answer that about the port traffic.
Yeah, sure. So where the container goes, which port the container goes, depends on which container has been chosen by the customer. It is the shipping line calling on that particular port decides how the container gets routed. So there are certain shipping lines which operate only Nhava Sheva and Mundra. There are certain shipping lines which operate only Pipavav and Nhava Sheva. And that's where the decision point lies. It is neither an option available with the shipper, the exporter or the importer, nor with a container train operator where to take the container. The ownership of the container decides to which port it goes to.
So for our life, it makes no difference whether this goes here or there. Our profitability and our growth depends on neither of these two elements. Is that correct? My understanding?
Any large shift resulting from one port to the other port may disturb our import-export imbalance, and that will have an implication as far as our unit cost of transportation is concerned. But it doesn't happen normally. There are occasions on which some shipping lines shift their calls from Mundra port to Pipavav port and vice versa. So there is some amount of change which takes place on account of that. But it is only one or two services which get shifted like this, and that is why it doesn't have a great impact on our overall business economics or business dynamics on account of such decisions. So we are largely unaffected by it.
Got it, sir. Thank you very much, and all the very best, sir. Thank you.
Thank you.
Thank you.
The next question is from the line of Aditya Makharia from HDFC Bank. Please go ahead.
Yeah, hi. I had a couple of questions. Concall is now stating that they want to focus more on domestic, and that will become maybe 40% of their revenue or whatever the number it is. So is the competitive intensity from them reducing, or do you see them pulling back from certain ICDs or CFSs?
No, Aditya, that won't be the case. I mean, they will continue to do admin business, and in addition, they want to increase the domestic volume. We keep on studying this domestic movement, and we still feel that it is premature for us to enter into the movement in domestic cargo because of various reasons. One of it, the turnaround time is quite high. Second thing is imbalance on both the sides. I mean, there are certain cargo which can give you 100% capacity on the rate, but to take that rate to that place, I mean, you have to zigzag through various locations where, I mean, the empty running is also taken into account. And then the margins are very, very low right now. So we would consider it once, some other sectors like sections like north-south freight corridor or, east-west corridor which are, I mean, announced and they will come, but it is still very distant, I mean, it will come in the next 8 to 10 years. So our focus is on EXIM business for now.
Okay, that's fair. Second one for Sachin, just if you can give us timelines on DFC, from Palanpur to Sanand, Ahmedabad, when do you see the line getting ready? Because there were some comments saying that this should start maybe in the next month or so.
Palanpur to?
Down towards Ahmedabad.
The construction up to Makarpura, which is Baroda, is underway, but nowhere close to commissioning. So I won't say couple of months, but by December we should see the dedicated freight corridor getting connected to Baroda. One of the obstacles that there is the clover which has to be built at Sanand. And that clover has not been yet completed. And unless that clover or Y connection on flyover is completed, that connectivity will not be complete. So I don't foresee it happening in next couple of months definitely. But by December there is a chance that Baroda may get commissioned.
Okay, thank you.
Thank you. The next question is from the line of Ashish Shah from Centrum Broking Limited. Please go ahead.
Yeah, thank you for the opportunity. Sir, we briefly spoke about this price increase which was taken with effect to October in a couple of phases. But, when I look at the numbers on a reported basis, we don't see any increase in the realization from second quarter to third quarter. So is it that in the fourth quarter we are likely to see some uptick on the realizations?
The increase in prices has benefited primarily the Ludhiana business, and it has not been taken in NCR. So we took it by coming out with traffic imbalance surcharge, and it is applied only on the routes on which there is imbalance. So it is not a 1,000 rupees increase across the board on all containers. So you're not likely to see that kind of benefit, and there is no currently the market doesn't allow that kind of across the board price increase by all operators, unless there is a action taken by one of the bigger operators and others follow. So the benefit of that is primarily to take care of additional increase in cost at these terminals. There has been inflationary pressures. And you must have seen that over a period of last 2 years, in spite of inflationary pressure, we have been able to improve our margins at various locations. We had done a similar exercise in the month of April for Gadi Arsaru terminal, and we have been able to push this price increase for Gadi Arsaru terminal to some extent. So it has come in small lots as a benefit in terms of intensification of our EBITDA. And this is something which has happened in the month of September, October, only for Ludhiana business, and that too only a part of Ludhiana business.
And the other thing is, I mean, the fuel prices have been going up, and a lot of our, utilities like generators, restackers, and trailer movement within the terminal, and the forklift. So all these things, we cannot pass on each and every time the fuel prices go up. And on last mile and first mile, we have been able, our contracts are linked to the fuel prices, but otherwise all other utilities, and equipment, we have to bear those costs, until the next price increase is made on that account.
Sure. So, connected with that, earlier we had said that once the DFC benefits are more tangible, we could see our EBITDA per TEU rise potentially to, let's say, 9.5 or thereabouts. But could we say that in the near term, it could be restricted to, let's say, around 9,000 odd, as we said earlier in the call?
No, it will be 9,000 for sure that we have achieved successfully in the last two quarters. And our aim was to go up to 10,000, but some inflationary costs, as I mentioned, have resulted in some costs going up. We are still looking at what you said, 9,500 in the current or the next quarter. But I mean, at same time, you know, there is a lot of empty container movements, which which has a very low margin or no margin at all. But I mean, we do it in the interest of repositioning of containers for the shipping lines to our terminal, so that we get that additional volumes, because the availability of containers is an issue, especially on the export side. So that helps in increasing our volumes. So if the margins are slightly lower, I mean, the volume increase justifies that.
Got it, sir. Got it. Just lastly, on the freight side, on the haulage side, we've already indicated that probably the rebates may not continue beyond April. But given that in general, because of the fuel price inflation, etc., is it possible that even the railways may come and actually increase the haulage, which they have not done for probably maybe 3 years plus?
This is a guess, what the railways would be doing. Our effort is to even bring down the tariff, not the tariff means the haulage charges, because the benefits of DFC should be passed on to the end user, and that is how we will be able to, attract whether the lighter weight or heavyweight containers from road to rail. So what the railways will do ultimately, I mean, they will definitely look at the representations made by the industry, and at the same time, what will be their policy, when DFC slowly and gradually, I mean, especially in the Mumbai and Bihar sector, will be completed in phased manner over the next few quarters. So obviously the idea is to bring the logistics costs down, and we look at the railways to simplify this haulage charge in various categories.
And just to add to that in the past also the railway haulage charges have not been linked to fuel prices going up or down. So I don't think that even this time they will link it to that. And all the recent communication which has come in from various parts of the government and from also Niti Aayog reports, they are interested in increasing the share of transportation on rail instead of road. So as a strategy, they want to increase this, and they want the benefits to come once the DFC is operational in more and more phases. So I don't think that they will take a step which will harm this sector.
Got it, sir. Clear. Thank you. That's all from my side. Thank you.
Thank you.
Thank you very much. The next question is from the line of Achal Lohade from JM Financial Service. Please go ahead.
Yeah, thank you for the follow-up opportunity, sir. Just wanted to check, this EBITDA, what we say in the presentation, that includes other income, if I'm not wrong. Just wanted to clarify that, sir.
Sandeep, can you confirm, please?
Yeah, this number includes other income also.
Okay.
Quarter to quarter, quote on the same basis.
Yes. The second question I had was, is it possible to quantify any synergy benefit, with this restructuring? Is it possible to give some sense in terms of the, cost reductions or the revenue benefit what we can have potentially?
See, the process was on for more than a year, and because of the COVID restrictions and NCLT hearings were delayed and everything. So we have been, streamlining our organization in that respect. So the cost-saving process has been going on for quite some time, and it will continue now. The other thing is the combined cash flows of the company. If you look at it, one is on the asset from the cash flows and our EBITDA. Now our debt EBITDA ratio has come down. The debt is down. Second is the combined cash flows will enable us to borrow less and spend more from our own money. So, and from the balance sheet point of view, if you look at the combined assets, they are very good quality assets all over India. And the availability of 4 terminals of rail and 5 CFS at the port towns will enable us to give some benefits to the customers who are using it on pan-India basis. So that synergy would kick in over a period of time now, since it's all under one entity and we no related party transactions or other inhibitions are there. So we expect that we'll be able to offer a much more wider range of services at various locations over the next few quarters.
Got it. And just last question, if I may, with respect to the rail business, I know we do talk about more so about NCR and Ludhiana. Is it possible to get some sense in terms of the out of, let's say, third quarter 85,000 TEUs, how much would be Mundra, Pipavav, or JNPT? Is it possible to give some sense?
So roughly Mundra and Pipavav equal with about 40-45% each. Say 45% each, and 10% is with JNPT.
Understood. That's all from my side. Thank you so much.
Thank you. The next question is from the line of Bhumika Nair from DAM Capital Advisors. Please go ahead.
Yeah, good evening, sir, and congratulations on a good set of numbers. So you earlier said on the call that we've increased market share, which has moved to now 14% in the NCR region, which has moved up quite a bit over the last 2-3 years now. Is there scope to further increase this market share as we move ahead, or would it be fair to say that we're reaching on the higher end and we will be actually growing in line with the industry peers?
No, we will definitely increase our market share. So, and actually it's 16% now. So, Garhi is about 11% and Faridabad 5%. And we expect it to go up further.
Okay. In terms of the margin profile, we've really improved our margins quite well, now close to about 9,000 plus kind of TEU or EBITDA per TEU over the last couple of quarters. With the DFC benefits kind of continuing, as Sachin sir mentioned earlier, with the feeder routes to Mundra, etc., getting commissioned, plus the JNPT route getting commissioned sometime in the next 2-3 years, would there be scope to further expand the margin profile, or would we actually look to kind of pass it on and gain higher volumes and market share?
See, definitely we will be looking at higher volume. And this per TEU margin discussion, I mean, in some way it affects us, because everyone comes to know whether it is competition, whether it is railways, or whether the customers. Then they look for higher discounts, and so that is one reason why we want to going forward, not now or in the next quarter, but maybe over a period of next few quarters or in the next financial year, we would like to have a combined EBITDA of CFS and ICD. Because if we start talking about location-specific margins or CFS and ICD specific margin, then it fires back. It is. It is against our interest to, but we don't mind sharing information, whether it is CFS or ICD. But one of the purpose of merger and amalgamation was, apart from the other benefits which I just mentioned, the cash flows, the synergies, the costs and everything, is also, I mean, that company being one unit, when the company is projecting a stronger balance sheet with the very quality assets and the infrastructure that we have built and the capacity that we have to further, all our terminals in the north and in Gujarat. All the four, I mean, have the capacity to, if the volumes are there, we can go at least 3 to 4 times easily, with some additional capex. So we definitely, as a business, we look higher volumes. That is one of the strategy, and also improve our margins by not increasing the price to the customer, but rationalizing our costs on various aspects.
Sure, sir. So the other thing was in terms of Viramgam. We've been, skating up the hub and spoke between Viramgam and Ghadi. Can you speak about what kind of volumes are we doing out of this, and has the terminal itself started generating its own volumes?
Sachin, can you take this?
Yeah, sure. So one of the problems that we have faced in Viramgam has been during COVID times, the shipping lines have actually contracted their spread as far as ICDs is concerned. And that's why shipping lines are not willing to open their bail point or point of sale, as can be called, at multiple additional locations. And that is why shipping lines which we normally do business with, though are inclined, have not been able to help us in opening BL point at these locations. So though we have 3 or 4 shipping lines which are operating from that terminal, currently we are operating roughly at about 600 containers per month as an average. And we expect that the overall volume during the current year should come close to roughly about 8,000, 9,000 containers. Current month we are seeing some traction. Going forward, we are concentrating more on exports, because in case of exports, you don't need a BL point opening. And acceptance has increased. We have also started reefer services out of Viramgam, which is becoming quite popular in Nhava Sheva direction as well as in Pipavav direction. So there is a traction, but the growth there is much slower than expected. We would like to grow much faster than what we are doing currently.
Right. And sir, in terms of the hub and spoke benefits out of the terminal?
Can you elaborate?
I mean, yes, sir. So basically, with the Viramgam being operational, we were looking at increasing the double stacking between as a 2 hubs between Ghadi and Viramgam. So, how are the volumes scaled up on the hub perspectives? Because that also helps in terms of our JNPT volumes as well.
Yeah. So currently, all our JNPT volumes in import as well, whether it is laden or empty, are routed through Viramgam. And if we look at, let's say, a monthly volume, we roughly have about 1,200, 1,300 containers import volume and another 500 containers of empty volume, which is coming from Nhava Sheva. Similarly, 1,500 containers go in Nhava Sheva direction. So over a period of time, we have been able to shift all these 3,000 containers. Not exactly, it will be a little lower than 3,000 containers a month, going towards Nhava Sheva, being carried on double stack for part of the distance, only up to Viramgam. So that has resulted into our unit cost getting managed better.
Okay. This helps. Great, sir. Wish you all the very best, and thank you very much.
Thank you.
Thank you, Bhumika.
Thank you very much. Ladies and gentlemen, that was the last question for today. Participants have missed out due to time constraint. They can reach out to the management and SGA. On behalf of Gateway Distriparks Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.